Like the bright green shoots emerging through the frost-hardened earth each spring, the economic data brings with it a patchwork narrative of renewal and resilience against the backdrop of lingering winter chill. It is a season of transition, rife with nuance and contradictions that confound easy analysis. On its face, the European Central Bank's forthcoming reduction of borrowing costs seems an odd contraction at a time when inflation lingers above target. A 0.25 percentage point cut to the ECB's 4% deposit rate feels, in the words of JP Morgan economist Greg Fusisi, somewhat rushed and odd given the recent uptick in Eurozone inflation from 2.4% in April to 2.6% in May. Yet such a hawkish stance belies the signal corps of policymakers who have telegraphed this very cut for months. The ECB, like an elite cadre of economic skydivers, has spent the elongated ascent laying out its jump plan only to pull the ripcord at what outside observers deem an imprudent altitude. To the sober analyst, sticking to prior seems the wise course, waiting until the economic landscape is less obscured before committing to a rate-slashing regimen. As Fusisi frames it, the cost of waiting until September appears low, while the benefit of getting more clarity on the inflation outlook appears high. But the ECB move, while daring, reflects a longer game being played. The central bank's playbook seems to acknowledge that restoring economic vitality will require an aggressive stimulus now, when multipliers may be higher. A conservative wait-and-see approach could mean missing a crucial window when the policy potency is highest. This bold tactic is not without hazard, however. If the inflation ivy persists in its kudzu-like advance, strangling growth in its vindictive sprawl, the ECB's premature cuts could appear ill-timed and inept. Particularly if the Federal Reserve and Bank of England elect to keep their powder dry for intervening months or years. The ECB no doubt hopes to defuse such criticism by downplaying May's inflationary bulge as a passing fancy driven by transient factors. But the gauntlet has been thrown. Either the old guard was prudent in seizing a closing window of economic malleability, or else with their easy money ways has doomed the euro area to a prolonged spell of feverish prices. On the Western Front, all eyes turn to the monthly U.S. jobs report to gauge whether April's cooler labor temperature represented a blip in the sizzling trend or portended the start of a deeper labor freeze. Economists anticipate a rebound to 180,000 net new jobs after the anemic 175,000 reading in April. The April slump briefly buoyed market hopes that the Federal Reserve might accelerate its forecasted rate-cutting timeline from late 2023 into mid-year. But a resumption of robust hiring could snuff out such reveries and reinforce the Fed's stated patience in awaiting clearer momentum in the disinflationary process. Some skeptics contend the dreary April jolted mostly reflected calendar quirks around the timing of Easter rather than a pronounced labor downshift. If so, a May rebound could realign the jobs data with the broader economic narrative of deceleration gripping the land slower, yes, but still expanding at a degree that leaves the inflation wolf lingering at the village gates. Such a Goldilocks labor market, neither too hot nor too cold, would likely reinforce the Fed's current posture of inaction at upcoming meetings, while leaving the door cracked for a potential rate cut or two by year's end. A policy pause to assess whether cumulative tightening to date is feeding through to lower realized inflation. Any whiff of persistent labor strength, however, could compel Powell and company to shelve any 2023 easing altogether and reserve ammunition for a potential re-acceleration of price pressures sometime in 2024. In the Fed's dot plot cosmology, taking its foot off the economic brake pedal too soon could send the inflation comet blazing anew on an undesirable trajectory. Across the Atlantic, vagabond investors have mounted a mini revival for the once bedraggled British pound. The currency of Milton and Chaucer clawed back some of its endemic weakness in May, rising 1.7% against the dollar amid evolving sentiment that the Bank of England may hold policy rates higher for longer than originally projected. Some of this renewed poise may reflect the scheduled changing of the Prime Ministerial Guard in coming months and lingering hope that fresh leadership could usher in a period of welcomed political stabilization, smoothing the UK's relationship with continental partners and catalyzing investment inflows. There remains a distinct scent of skepticism in certain corners, however. Kit Jex of Société Générale warns that a significant rally requires a clear improvement in growth prospects and expectations of rates remaining high for considerably longer. The ephemeral political purification ritual baked into an upcoming election may provide temporary balm without altering Britain's underlying economic fragilities in any durable way. Looming over the pound's path remains a lingering question of latent fiscal capacity. How much economic excess remains in Britannia's saddlebags for a new prime minister to channel stimulus through expansionary spending? Given the pound's institutional memory of repeated devaluations over the past decades, any missteps in demand-side stoking could singe sterling anew. Such is the economic landscape in 2023, lush with conflicting signals and cross-pollinating narratives, an interregnum between the frigid militant disinflation of 2022 and the indefinite reversion toward the tepid 2% neighborhoods of yore. Optimists revel in spring's grand reawakening, while scarred veterans warily await the next frontal system to roll through with its chilling surprise. Perhaps we are doing all of this backward, treating inflation like an encroaching menace, to be hunted to extinction through arduous CIRP and QT campaigns. Could it be that the true endgame is not the nihilistic voiding of price pressures, but their prudent subjugation to a permanent, well-behaved sidekick role? If the deflationary vice grip persists too long, could we arouse a more pernicious force in the form of a reactionary inflationary monster bent on vengeance? Yes, our monetary naturalists remain dutifully on inflation watch. But as any ecology student learns, the eradication of an indigenous species invites unpredictable ramifications from self-reinforcing imbalances in the broader system. Sometimes, the studied preservation of certain regenerative price pressures represents the wisest path. This is the fraught backdrop confronting our policy pilot guides as they steer their economic aircraft through corridors of conflicting drafts and oscillating conditions. They must continuously update their priors based on the latest upper atmosphere readings, while never losing sight of their long-run objectives. It is a delicate tightrope act, buffeted by rhetorical squalls from those fixated on discrete moments while losing sight of the broader spatiotemporal trajectory. Those gifted with the long-lens perspective appreciate the challenges and audacity of the maneuvers currently underway by our monetary masseuses. Like skilled healers, they intuit that the ameliorative process demands active manipulation and judicious injection of counter-pressures. Too brusque a technique and the inflamed region stiffens in aggrieved recoil. But too delicate a touch and the pathologies fester in dank recesses, entrenching further. There is an art and science to rebalancing an unbalanced system, a craft honed over generations of study and practical experience. The deft practitioner recognizes that heavy-handed techniques often make matters worse by inflaming systemic defenses. The infinite wisdom knows that sometimes, when the body is in distress, the wisest course involves neither invasive surgery nor pharmaceutical bombardment, but patience and a light, practiced touch aimed at piquing the biological intelligence to reset its own self-healing mechanisms. A skilled physician does not battle the body's symptoms, but works in subterranean concert with the body's regenerative forces, channeling flows in pursuit of integrated balance. She applies deficits and surpluses with complementary intention, like arranging harmonious musical movements aimed at stirring dormant resonances within. Those playing the short game see only erratic trills and martial cacophonies on the surface. But distance reveals a grander, more coherent symphony, taking form through the chaotic opening movements. Our central bankers are composers of this variety, modern-day economic musical theorists arranging instruments and introducing judicious counter-melodies designed to harmonize the discordant movements of inflation and growth into an integrated, self-regulating system. The cacophonous trills of easy money in decades past set mercurial inflations loose, to stampede roughshod through the real economy. But rather than respond with shock and awe monetary artillery baying for restrictive overkill, our present orchestrators pursue more nuanced phrasings and interplays of tightening and release. The recent ECB rate trimming represents one such dexterous musical passage, a stretch of minor accidentals designed to curb excessive disinflation while avoiding the blunt, percussive hawkishness that could induce economic arrhythmia. It is a gambit with palpable risks, but one that probes for organic responses from the inherent regenerative capacities rather than beating them into mute submission. Similarly, the Fed's apparent pause while prioritizing realized disinflationary momentum over bubbly labor pricing points to a more holistic approach to systemic rebalancing. An excessive jobs crunch sows the seeds of future inflations, just as surely as excessive jobs euphoria stokes near-term price hassles. The stable resonance of full employment is not an absolute floor to be knocked through at all costs, but an artfully maintained residence between disinflationary and inflationary extremes. In the UK arena, the pound's fitful rallying may portend more than speculative pricing of electoral palindromes. If the new regime wields its fiscal toolbox with judicious remedy, it could augur an accelerating rebalancing of trade and capital accounts through the alchemical reactions of a properly valued currency. As always, it comes down to the skillful dosage and complementary alignments of monetary and fiscal policies. Apply too much deficitaire trough and the inflationary embers reignite, but malnourish the body economic for too long and the deflationary wasting disease takes mortal hold. All across the global policyscape, we see these intricate concert works in progress. The clattering overtures and atonal warm-ups have given way to more structured improvisational movements in pursuit of integrated restorative harmonies. Each institutional orchestra introduces instrumental passages aimed at stimulating restorative capacities through the body economic. There is no perfected score to follow, only guiding principles absorbed through study and adaptation. The Chinese authorities guide their economic instrumental voices in consideration of the broader global ensemble, just as the European and American conductors continuously incorporate influences from cultures abroad. It is an exercise in studied spontaneity, fueled by ample rehearsal and insight into generational traditions. Those gifted with sober second sight appreciate the superhuman complexities confronting our monetary artists. These are not mere financial plumbers forced to jackhammer through inflation clogs or drain liquidity backups. They are Renaissance demiurges delicately rekindling equilibrating flows through a single integrated, non-dual field of energized potentials. Clumsy interventions cause violent dislocations and adverse reactions. But meticulous modulations and complementary pressures catalyze integrated balancings and realignments of systems pushed asunder through previous spates of imbalance. Like accomplished yogis, our wise monetary guides pursue mastery through sustained practice and embodied intuitions drawn from harmonizing with the deepest laws of nature rather than resisting them. Not conquerors, but midwives attending life's ceaseless renewal through eons of uninterrupted fertility. So let the pedants howl from their bunkers, their vision clouded by dogmas and hatreds from bygone eras. With the patient equanimity of devoted gardeners, our monetary regents continue tilling the economic soil through sagacious season after season, nurturing environments conducive for integrated symbiosis and natural equilibrium to take root. Their labors may appear scattershot and impatient to the agitated optic. But seen through the long lens of civilizational time, these subtle interventions represent mid-course trimmings along humanity's multigenerational journey toward balancing its consumption and vitality flows with nature's regenerative source code. Look not to these latest rate rockers or gently inflected fiscal chords as ends to themselves. They are humble passages within a grander integrated resonance, economic Sherpas guiding our economic ascent to those elevated ranges where inflation and deflation harmonize into background instruments, allowing the broader human symphony to ring out in all its majesty.